Welcome everyone, and I'm recording this on the 18th of December, so just a week before Christmas literally. So hoping everyone is going to have a great Christmas and just what a difference a year makes. This time last year I was madly emailing out to everyone as the Aussie market was down 10%, the US market down 20%, and just remember emailing out saying, be reassured, these things happen regularly. This is our monthly update for the end of November. I'm going to talk through what's happened for the month, a little bit about what's happened for the year, and why it matters or doesn't matter. So firstly, a general advice warning. This video is for clients of McGregor Wealth Management, particularly those that use the care investment process. For anyone else that stumbles upon this, please treat this as general advice and seek out advice that's relevant to your own circumstances before acting on anything. So let's get into it. As usual, I'm going to go through the economic news, put into context around the market, look at what the markets have done over the last month, but also the last year and beyond, and put it all in perspective. So some highlights in the news in Australia. We're muddling along. Growth-wise, the forecasts are we're going to grow at about 2.25% for next year. So it's on the low side, but it's not terrible. Inflation at 1.6%. That's lower than the RBA's target of 2 to 3, and they just can't seem to get it into that range, and it's unlikely they will. All the forecasts for the next few years are around that 1.6%. I'll talk about what that means as we go through this. Unemployment rate is steady in the low 5s, and the RBA cash rate is unchanged at 0.75%. You'll get about 1.6% on a term deposit. There's the odd special around which can make that better, and that's for 1 or for 3 years. So that's telling us the banks think the rates aren't going to change much, and the 10-year government bond rate is 1.171%. So not quite at the record lows, but certainly not much of a return for lending your money to the government for 10 years. And that's the risk-free rate of return. So that is the least riskiest investment you can make. So it tells us we're in a very low return environment, which we know. Internationally, we saw the UK election result in a landslide to the Conservatives. Boris Johnson back in, which means Brexit should be likely. There's still lots of things that can go wrong. It's going to be interesting to see. The pound reacted strongly to the positive. So as is often the case here, often markets go down worrying about things, but as soon as they know something for certain, they'll recover because people start to think it's not going to be as bad as we think. So I think Britain certainly showed they're ready for Brexit. There's still lots of hurdles there. I don't believe it's an issue to be worried about for Australia. Australian economy actually probably has some opportunities out of it, as we can been limited from doing some trade deals with the UK because of their membership of the European Union. Global growth is stuck at around 3% and looks like it's going to be there for the next few years. Once again, it's not scarily low, but it's not around the averages as well. We saw Trump announce a resolution, so we say a truce in the trade war. They've called it Part 1. Markets jumped up a fair bit, but not as high as I would have thought, and that's because when you look under the bonnet, there's not much of a truce here. They're pretty much saying let's agree not to make this worse. They're not taking away too much. They've made some vague promises. The devil will be in the detail, but make no mistake, this is the start of a decade-long war of power between the US and China for economic supremacy. So this is going to go on for a while. Both are growing well. I don't see it as an issue to the market. It will limit world growth somewhat, but it's not something to be scared of. And I'll show you what the market's done shortly with that. US growth is solid in the mid-2s. China's about 5.5% growth. Lot lower than the growth of past years in China of 6, 7, 8%, but off a much higher base these days. An interesting statistic that came out during the month: the Chinese consumer in aggregate, so all the Chinese consumers now spend more than all the US consumers. That's the first time in history. So a very powerful force, the Chinese consumer, and they're spending money. And as their wealth grows, that's going to be a positive for the world, because they are buying iPhones, they are traveling, they are doing other things. And for a lot of global brands, they're doing good business in China, and the sheer growth in China means they can expand rapidly in China and increase their profits. So one of the fund managers we use in the care process, Magellan, has a third of their portfolio positioned for that growth in China, but through global brands. So the continuing theme, low to moderate economic growth, low inflation, low interest rates. Share markets are climbing the wall of worry, and they're giving us good returns, but in theory lower. Not that that's been the case this year. We've actually had good returns, and I'll put them into context as we go through. I think we're stuck in this pattern for a while. I don't think it's a bad thing for investors, as long as you prepare yourself for returns that sound low. And I'm talking about returns from share markets of 6 to 8%. But if you take away inflation, it's still inflation plus 5 to 7%, which is pretty much where it's always been in real returns. And real returns are all that matters. Tough for those people who are just trying to live off interest rates, term deposits, etc. We're seeing quite a bit of interest from new people who are in the term deposit market and just can't live off that anymore. Let's get into it. And just a reminder of the foundations for all good investment strategies. One is a plan that's based on your own circumstances, what's important to you, your goals, how you want to live a good life. We take our time to learn a lot from history. Understanding history hopefully helps us avoid the mistakes of the past. We understand and manage the behavioural trap, so that's the humanness in us that makes us panic when things are down, that makes us get greedy when things are up. And if we avoid those traps, we're well on our way, and we can then get down to smart investing. And I saw a great quote from Paul Clitheroe during the month. Sorry if I've repeated this, but it is great. And he said he's found that the simple proven principles work really well with investing, and everything else doesn't. And that's been my experience as well. And we've seen that come through with solid returns over the last few years. So the framework that we use, the wall of worry. So if you look at the scribbles on my whiteboard there, we talk about the market going through the boom, or FOMO, fear of missing out, then a bust, which is fear, based on those human emotions of greed and fear, although they're both fear, because greed is just fear of missing out. And then the wall of worry, which is 80% of the time. And during that wall of worry, we tend to rate markets as expensive, fair and cheap, which just gives us a context when we're making decisions, particularly for money that's on the move, putting new money in, pulling new money out, and just to keep the portfolios in balance. If you have a look at the chart down the bottom, it shows the Australian share market back to about 1990. And it's a clear representation. So this is the market, not the model. But you'll see that boom. And have a look. Right now, we're at about 6,800. And you can see that on the right-hand side of the chart. So we're just passing the peak of 2008. And some people get worried about that. We're at new highs. But it's taken us effectively 11 years to get back to that peak. That's the longest it's taken. And the low after the GFC was down around 3,200. And that was in about 2009, and it's taken 10 years to get from where it is today, which is about a double on that. If you go back and you look at, and if you can see my cursor, that low there, and if you go back, the low previous to that was 2005. So between 2005 and 2008, which was 3 years, the market went from 3,200 to roughly 6,800. So 3 years to more than double. After the downturn, after that bust, which is absolutely inevitable from a boom like that, it's taken 10 to 11 years to get back to that level. So 3 times as long. So we're certainly not in any boom. We're certainly not in any elevated level where the likelihood of a bust is high. I think it's actually quite low, just given how slow this recovery has been. So that's the context. The other context is what most people do is they mess it up, and they mess it up for one of these reasons, and mess it up's just the acronym. They focus on the media, and I'm going to talk more about the media's focus today. That leads to emotional decisions, that fear and that greed, that panic, but usually based on short-term issues and single issues. We've been obsessed with the trade war for the last year, although less and less in the last few months as markets tend to brush it off. Illiquidity is only one of 3 ways to lose money in the long run, the others being when people aren't diversified or when they panic and sell. Timing and selection, we all think we can time the markets. Nobody can. We can always get a sense of whether the market's hot or cold, but we need to make sure we do that carefully without focusing on what the media is focused on. And diversification cures so many ills in investing. Good quality diversified portfolios, as we all have, means we get good quality results. And just again, that reminder, diversification is where we bargain away the right to make a killing in return for never being killed. A fair trade, I think. And to focus on performance, I see way too many people they come in to see me and they've got an investment that they're talking about going into that's performed really, really well. They want to go into it, and they may perform well in the future, but unfortunately past performance is rarely repeated, particularly with active managers. The market itself will go through the cycles we've talked about, but people that outperform strongly are very rarely going to repeat that, and we just don't see it at all. So let's get into my theme for the month, and this theme is about it comes out of the media reporting about what's happening to the economy. The economy's in recession. I just want to point out, as I have done before, the economy is not the market, being the share market, and the market's not the economy. They're absolutely linked. And in these couple of charts, I'll try and show some of those links, but they're certainly not linked in timing. So the top chart here shows growth in the Australian economy back since 1960. And you'll see most of the time we're growing. Growth was higher in the 60s, 70s and 80s. Don't forget inflation was higher then as well. So the real growth was fairly steady if you take away inflation. We'll see occasional periods of contraction. So you see the recessions of the 1992, recessions of the 1983, 84, and then back to 75. So no recession for us since 1992. It's the longest run we've ever had, although we did technically, if you took out the mining industry in 2008, the rest of the economy would have had a recession. So fairly steady. The highest growth we've had is up around 9%, and the worst downturn is -4%. But then we look at the share market bar chart returns. Now the highest growth we've seen in the share market is 60%. So even though we're hitting returns of about 19-20% for this calendar year, and I'll put those into perspective shortly, it's certainly not the 60% that we saw in the 70s, and even back as far as 2009, we saw a recovery that was more like 30%, and we saw, from in the lead up to the GFC, from 2004, 5 and 6, we saw average returns of about 18%, which caused that market to double during that period before it inevitably and logically corrected before being back in the wall of worry. So we see the market's a lot more volatile than the economy. We see the timing is not linked. We see a recession here in the 90s, which was followed by a booming market. In fact, buying during a recession can often be the best strategy of all. Back in the 80s, we saw 2 stellar years followed the recession. So don't be scared of recessions as investors. And I think often the market has predicted recessions. It's always hard to know whether the market's, when it goes down, is predicting a recession. And part of me believes the drop we had last December was predicting the slowdown we've seen in world economies that haven't turned into recessions, but many did predict it. So my conclusion, in looking at this, and my point here is that low returns, we're in a low growth environment, as I've said, so low returns should be expected. But when you allow for inflation, which is real returns after inflation, they're going to be consistent with history, which is that inflation plus 4 to 5% for balanced investors, 5 to 6 for growth, and maybe a fraction higher for high growth investors. And in any one year, anything can happen. The market can move around reacting to news. We've got a presidential election year coming up, so we're going to have lots of news flashes that may cause markets to worry. So that's not an issue for those of us, the long-term investors. But from current conditions, as I said earlier, large drops very unlikely. So let's update and go around the markets. Aussie shares up for the month of November 3.1%. So they're going to finish the year, to the end of November, they're up 25%. As I said in last month's On Track, there's a bit of lies and statistics in that, because last year, if you recall, we finished the year slightly negative. So if you average those out, we've pretty much had 10 to 12% years, depending on where the market finishes up, which is very consistent with our long-term historical returns. And you'll see here in the charts, I've got the 1 year chart on top there, which shows the Aussie market going up almost continuously through to July. We pretty much have held still since then. Even though the published returns have gone up, that's because we've been dropping off some bad returns. And if you see the 2 year chart in the bottom right, you'll see that quite exaggerated drop there from sort of August through to January, where the market did drop 10%, 20% in the States, and then we've seen a nice steady increase since then. So over the 2 years, we've actually merely gone up about 10% on the market plus about 10% in dividends, so about a 20% total return, or 10% per annum. And look, that's bang on track in terms of long-term history. So don't believe anything that comes out in the media about record highs and record year meaning danger. We're just sitting in the average. US shares, much the same story. There's the 1 year chart on top, then the 2 year chart there that show exactly the same story, but a bigger drop in the US. It was actually closer to a 20% drop. And down the bottom, we show the stock that we actually own in the core portfolios, VTS, Vanguard US Share Fund, which is up 27% in Aussie dollar for the year. There's about a 4% boost on that for the currency, and that's 27% is today as I'm recording this. To the end of November, it was about 24%, so it looks like being up around 28% for the year. Once again, people are going to view that as being record highs, but if you average it out over the last few years, it's a little bit, it's above average for the US, but once again, we're recovering from that GFC still. And so the returns are not abnormally high. We view the US market the same as the Aussie market, is in that fair to expensive range. It can stay there for a long time. We don't believe fair to expensive is any reason to worry about. And I'll talk about how you would manage money on the move shortly. US small caps up for the year, about 12.79%, up for the month, 4.9%. The increases we saw in the month of November were partly due to that resolution of trade war being anticipated, and you'll see in the charts we saw a jump then. The V, where I'm pointing my cursor to at the moment, is pretty much where the trade war likely deal was announced, with Trump saying we're just about got a deal. Market jumped, but it's sort of flatlined since then, as the details are probably not going to prove to be anything really magnificent. We think US small caps are fair value. They've pretty much had a sideways year for most of the year after a downturn, and you'll see in the 5 year chart here quite a significant correction in the lead up to in 2018. We were out of the market in US small caps in the active portfolio for part of that time, because they'd had such a good run. Very happily to be back in, and we view them at fair value, because historically US small caps outperform the rest of the global share markets, because they're the engine of capitalism, and that's where all good growing companies come through. And small caps in the US would fit in the top 100 in Australia, by the way, so they're not that small a company. Global leaders, so we have this in the portfolio through IOO, which is the 100 top companies in the world, which includes the Googles, the Facebooks, and the Microsofts, the Apples, and all those big companies. So you'll own those in your portfolios. Another good year, 24% there. Another good month, 4.7%. Same messages as the other markets. It's really recovery from that dip last December that's causing the 1 year numbers to look so good. But 3 year numbers pretty good on 17.8, and the 5 and 10 years at just above long-term historical. And we also view global leaders to be fair to expensive and still a very important part of the portfolio. Emerging markets, and excuse me, the joys of recording live. I'll just turn that off. A funny story, I'm recording this in my car. I was meant to fly on an early flight to Sydney this morning with Jetstar, and guess what? They cancelled the flight, so I'm waiting for a flight 4 hours later. I had planned to record this from our office in Sydney, but I now got to run straight into appointments, so I'm recording this in my car at Maroochydore Airport. Luckily, the joys of technology allow this stuff, so apologies for that little interruption there. So emerging markets, which really took the brunt of the trade war, and you'll see that in this chart down the bottom, the decline there from 18 all the way down was caused by those initial bouts in the trade war. So we'd seen emerging market returns drop. We've also seen them secondary over 10 years. You'll note 5.6% there. We've seen a recovery in the last year, but we actually think emerging markets are cheap. They form an important part, albeit a small part, of the core portfolio and the active portfolio, and we think they'll benefit strongly from a resolution trade war. And you can see that in the top right hand corner here. You can see the sharp jump in emerging market shares following that resolution, and that's because it's the smaller companies in emerging markets that stand to lose most from a trade war, as particularly around as US and China restrict sort of trade, or that's the theory anyway. Gold has retreated as the trade war. Often as markets go up, gold retreats, and we see the opposite there. You'll see that downturn this year. Steadily, not dramatically. We still believe gold is a very important part of the portfolio because it's just insurance against all those ups and downs. It's also a solid currency in of its own right. It's been a good performer for the year still, 27%, and that's brought the returns up over the last few years. So very important part of the portfolio, which we will continue to hold for the long term. The performance of the care portfolios to the end of November has continued to be solid and in line with targets. When I look at the 5-year returns, they're well and truly in line and slightly above expectations of what we put into your plans, which is really important because that allows us to plan the rest of your life and the rest of your finances reasonably well by knowing that we can deliver returns in accordance with that plan. 1-year returns are looking high. You'll see high growth up to about 20-21%. Once again, keep in mind that average is really, if you look over 3 years, that's more like what we've had, and if you look over 5 years, the 10. Balanced approaches, getting 15% in the last year. It's been a great year, but really considering we got 0 last year, it just gives us back the averages, and that 5-year average of about 7.63. So happy with returns, never complacent on those, but we'd expect more of the same next year, barring anything unforeseen, which is always highly likely. Property continued to rebound in Melbourne and Sydney, so up another 2.7% for the month in Sydney, 2.25% in Melbourne, so they're the best performing markets in Australia at the moment, and that's the rebound. Brisbane still solid. Melbourne and Sydney not quite back for 12 months, so if we look at 12-month return, sorry, Melbourne and Sydney are back over 12 months, they're now positive. It's interesting, the other markets seem to have taken a little bit of a dive. We think Perth, Brisbane represent incredible value at the moment in their relativeness to Sydney. For those where property is a part of their portfolio, and Sydney, Melbourne past the worst, but unlikely to show massive gains you would think over the next few years. But it will be largely driven by population growth, which is still growing strongly. Heron Todd White, our friends, have the property clock here, and a few changes there. Adelaide, they're calling at the bottom of the market. Sydney and Melbourne, as per last month, in the start of the recovery. Fascinating, they have Sunshine Coast at the peak of the market. They don't have it declining. That's different to what I'm seeing, and I feel like we've, particularly that Noosa and the quality end of the coast, that's the high lifestyle properties, whether that be a Mooloolaba, a Noosa, seem to be having a bit of a run based on the same forces that are driving Sydney and Melbourne, and that's confidence in those markets means we're having a bit of a run. So who knows? I'm very comfortable with Sunshine Coast property in the long run. Our philosophy is there for those that own properties is around growth capital cities. That's Sydney, Melbourne, Brisbane and Perth, and within sort of 2-hour drive from there, and that's the only place we believe is investment grade property. You may get other stories like Hobart that are recovery stories, and Tassie may even turn into a growth state. We're seeing people migrate there partly because it's cheap, but partly for environmental reasons and partly for health reasons. It's becoming a healthy place, so we may see Tassie turn into a growth state. It hasn't been, nor has South Australia, so we think those markets, you can make some money sometimes in the catch-up, but we just don't think they're going to grow as long-term as those growth cities will. Units, much the same, and Herrontoe White didn't change any of that. So same story from there. So let's put it all in perspective and wrap up for the year. Current conditions mean, as they always do, steady as she goes. Stick with the plan. It's actually a reasonable time to be buying or selling. For those buying with large lump sums, we are averaging in a little bit, and we're always happy for our wealth accumulators to be dollar cost averaging in a market like this. There's always going to be better times to buy or sell. You can't tell that, which is why we love dollar cost averaging, and not talk about how we manage the volatility. But if markets do get a little bit more expensive, then we'd average money in a little bit more. And as markets get more expensive, it's always a great time to rebalance and top up those reserves, or make those withdrawals for some lifestyle expenditure. New cars, etc., are often best made when the market's running well. And we'll continue to review as we sit down with you, as always. So just to reinforce our process, and it is based around our philosophy that you should have an exciting life and boring money, and not the other way around. And goals first. So quite clearly, what do you need to live a good life based on who and what's important to you? Portfolios designed to meet those goals. Quite boring, beautifully boring portfolios, massive diversification and liquidity, low cost, that will allow us to see those goals. And we see that coming through in the consistent returns. We take a long-term view, and even though I do this video monthly, the whole reason I do this is to put whatever's happening in the world in perspective, because we sit down with most of you once or twice a year, and it can tend to be dominated by whatever's happening in the world. Our conversations can tend to be dominated by whatever's happening in the world at that time. Back in May of this year, we were all talking about the election and the franking credits and so on. So by having this monthly video, it allows you to see the perspective of whatever's happening at the moment, and usually why it doesn't matter too much. Diversification, asset allocation and liquidity are our core principles. So massive diversification, having the right asset allocation to achieve your long-term returns, and then enough liquidity to get you through the inevitable market ups and downs. Low-cost indexing for most of our growth markets. We know that less than 4% of active managers will perform in the long run. So we know that indexing is the most effective way to get consistent returns. And protecting against short-term volatility by having adequate reserves for our retired clients, and dollar cost averaging for our accumulators and those with money that's new to the market, and rebalancing regularly. So that's it for 2019 for me. I've literally got 1.5 more days in the office. Any true emergencies, you can get me on the mobile. I wish you all a wonderful Christmas, New Year, and hope you have a great break and great time with friends and family, and hopefully we get some rain in the mix, and enjoy. So that's it for me. Look forward to talking to you in the new year. Have a great Christmas, New Year. Rob McGregor signing off.